Imagine you retire with $1 million and the market hands you the best 30 years in modern history. Your portfolio does not just survive, it runs. It doubles, then doubles again, and keeps going. And now imagine a rule that will not let you touch almost any of it. A rule that pays you the same check year after year, no matter how big that portfolio gets. You die with millions in the bank you were never allowed to spend. That is the retiree we are following today. Same $1 million as the unlucky retiree from part 1, but this one walked off the job in January 1982 into one of the greatest markets on record. And the 4% rule is about to fail them in the exact opposite way it failed the unlucky retiree. Not by running them dry, by handcuffing them to a paycheck that never grows while the portfolio screams they could afford so much more. If you are watching this worried that you did not save quite enough, that you are walking into retirement a little behind, this is the one to watch, because a good market early in retirement can do something the 4% rule never lets you do. It can let you keep building. It can give you the raise you earned. I am going to show you exactly how and how much bigger that paycheck gets. So here's the setup, and if you saw part 1, it is the same experiment, just flipped. We follow the same 3 strategies with the same starting portfolio balances. The only thing that changes is the year they retired. Part 1 retired in 2000 into the worst sequence on record. This one retires in January 1982 into one of the best sequence of returns. The first strategy is the textbook 4% rule, a plain 60-40 portfolio, a 60% in the S&P 500 fund, 40% in a total bond fund. You take 4% of your starting capital in year 1, $40,000 on $1 million, and every year after that you raise it for inflation and nothing else. It does not look at the market. It does not care if your portfolio just tripled. The check goes up with inflation and that is it. The other 2 strategies are mine. They both run the same withdrawal system, the hybrid 6% rule, and the same quarterly Treasury rotation underneath. The first is plain stocks and bonds, no options. Anybody can run it. The second is the hybrid barbell, a small sleeve of long-dated S&P 500 options for growth and a big sleeve of treasuries for safety. Same rules, just different portfolio makeups. Whether you trade options or never want to, there is a version for you. Brief overview of the rules. The hybrid 6% rule is a set of guardrails. You take 6% of the highest value portfolios ever hit, and it steps down to 5 and then 4% when the market falls, then back up when it recovers. There is a 4% floor that protects your income. There is a kicker that buys the market when it is deeply down, and there is a 9% ceiling so you never overpull from a beaten down account. 4 rules. But here is what is different about today. In part 1, the market was collapsing, so the stars of the show were the 4% COLA floor and the kicker, the rules that protect you on the way down. Today, the market is booming, so the star of the episode is the guardrail raise, the mechanism that lets your paycheck climb every time your portfolio hits a new high. Watch the raise. That is the whole show. If you want the full build on any of this, the portfolios, the kicker, the barbell, all the rules in detail, it is all laid out in my 2 playlists on my channel, the Foundational Flight Plan and the Glide Path to Retirement, both linked below. And I have done the work for you. Go to my channel and open either playlist and read the description. I have listed every video in the order that you should watch them and described exactly what each one covers, so you can see the theme of each video and jump straight to what you need, or start at the top and follow the whole path. And if you have not seen part 1, The Unlucky Retiree, it is also listed in this playlist. This is the other half of the same story. So back in time we go. This retiree clocks out December 31st, 1981 and walks into January 1982 with a $1 million portfolio, ready to run all 3 strategies. And the timing could not have been better. By January 1982, Fed Chairman Paul Volcker had finally choked the life out of the 1970s inflation. Interest rates were still high, but they had peaked and were on the way down, which is the rocket fuel for both stocks and bonds. Shares were sitting on the bargain rack after a brutal decade, and bonds were locking in yields that would make an investor today jealous. This retiree stepped into the single best stretch of returns in modern history, and they stepped into it on day 1 when a retirement is most fragile and a good run does the most good. So let us see how the 3 strategies handle a tailwind instead of a headwind. Same as part 1, a heads up before we start. This is data heavy. Every single year is on the screen as we go. I am going to tell you the story, the years that matter. But if you want to walk it dollar by dollar, Pause the video on the tables. The balances you see are the account value at the yearly rebalance, one snapshot per year. Stick with me or pause wherever you want a closer look. Right away before anything even happens, the three strategies split on the paycheck. The 4% rule retiree takes $40,000. Both hybrid 6% rule retirees take $60,000, living 50% better on day one. Then the 80s go to work. The S&P 500 returned 22% in 1982. Bonds returned 39% as rates collapsed. Every one of these portfolios is up big in year one, even after paying out his paycheck. The 4% rule retiree ends year one at $1.235 million. The no options hybrid 6% rule at about $1.25 million. The hybrid 6% barbell at $1.36 million. Everybody is already richer in retirement than the day they retired, and it is only year one. And now watch the raise. As these portfolios climb to new highs, the guardrail on both hybrid 6% rule retirees keeps paying 6% of that new higher high water mark. The check does not stay flat. It ratchets up. Every single year the portfolio sets a record. The 4% rule retiree, meanwhile, gets the same inflation bump and nothing more. By year 5, 1986, the 4% rule retiree is pulling about $47,000. Both hybrid 6% rule retirees are already pulling into the 80s and 90s because their check is a live 6% version of a portfolio that keeps growing. The 90s did the rest. The dot-com bull market ran almost the whole decade. By year 15 in 1996, the 4% retiree is at about $5.3 million. By year 2001, around $8 million, and the hybrid 6% rule portfolios are climbing right alongside, paying their owners a steadily bigger check the entire way. Both hybrid 6% rule retirees spend almost the entire retirement taking the full 6% raise because the portfolio almost never stops setting new highs. Now, the number that actually matters, the one you spend. Let me walk you through the paycheck itself every single year, all three retirees side by side. The ending balance is nice, but you do not live on an ending balance. You live on the check that hits your account. The first decade, 1982 through 1991, it opens with the split you already know. $40,000 for the 4% rule retiree, $60,000 for both hybrid 6% rule retirees. Then watch the raise take off. By 1986, the hybrid 6% rule retirees are already over $100,000 a year because the market keeps setting new highs and the guardrail keeps paying 6% of each new high. By the end of the decade, 1991, they are pulling around $134,000 and $146,000, while the 4% rule retiree, doing everything the textbook says, has crept from $40,000 to just $57,000. The second decade, 1992 through 2001, the hybrid 6% rule retirees are taking 6% of a portfolio that just keeps climbing. So the check climbs with it into the 200,000s and past the 300,000s by the dot-com peak. The barbell retiree crosses $310,000 a year by 2000. The 4% retiree, meanwhile, inches from $59,000 to $74,000 across the same 10 years. One quick note, you can see on the slide, the barbell dips to 5% for a single year in 1995 during a mild pullback, and then goes right back to 6%. That is the guardrail doing exactly its job, easing off for 1 year and then resuming the raise. The final decade, 2002 through 2011, is where you see the guardrails work in a downturn, and where the two hybrid 6% rule strategies part ways. Both stepped down at the dot-com bottom to 5% in 2002 and then the 4% lock in 2003, protecting the portfolio exactly as designed. Then look at the recovery. The barbell snaps back to a 6% raise by 2005 and rides it over $330,000 a year right through the financial crisis, dipping to 5% for just 2009 before resuming. The no options hybrid 6% rule retiree stays locked at the 4% floor, $177,000 a year all the way through 2010 because its portfolio took longer to reclaim its old high, then breaks back to 6% and $287,000 in 2011. And through all of it, the 4% rule retiree sitting on the biggest portfolio of the three is pulling from $76,000 up to just $94,000. The gap is staggering, and every year it is right there to read. Now, this retiree lived through the dot-com crash and the 2008 financial crisis too, same as the unlucky retiree. But by the time those hit, this portfolio was so large the crashes barely registered against it. Still, I want to show you the drawdowns because there is something that looks backwards at first, and the explanation is worth your time. Here are the two crashes measured the honest way, peak to trough, the deepest point each portfolio actually hit. In the dot-com crash, the 4% rule retiree drew down about 20%. The no options hybrid 6% rule retiree about 30%. The hybrid 6% rule barbell about 27%. In the financial crisis, the 4% rule retiree drew down about 27%. The hybrid 6% rule no options about 37%, and the hybrid 6% rule barbell about 42%. A withdrawal is a forced sale. Every year in retirement, you sell part of the portfolio to pay yourself, and the bigger that sale is compared to the portfolio it comes out of, the deeper the portfolio falls in a crash because you are selling into the decline. So the real question is not the dollar amount of the check, it is what percent of the portfolio that check represents. When the dot-com crash and the financial crisis hit, watch what the lucky 4% rule retiree is actually pulling. Their portfolio is now $8 million, then $10 million. Their inflation frozen check is at around $72,000, then $86,000. That check is less than 1% of the portfolio, under 1%. It is a feather. That is why their drawdown barely moved off the market. They are hardly selling anything into the crash. Now the hybrid 6% rule retirees, they are pulling a live 6% off their portfolio, right through both crashes. The barbell retiree is taking 6%, a check of $311,000 in the dot-com crash, $330,000 in the financial crisis, 6 times as much as the 4% rule retiree is taking. So of course the portfolio dips deeper. The drawdown difference is not extra risk, it is the weight of a bigger paycheck. And this is what ties it all together. Go back and look at the unlucky retiree from part 1. During these exact same crashes, the unlucky 4% rule retiree was pulling 5, 6, and 7% of their portfolio because their portfolio had been beaten down to well under $1 million. The lucky 4% rule retiree with the exact same rules, the same crashes, and the same 60-40 portfolio was pulling under 1% because their portfolio had grown to millions. The only thing that changed was the ratio, the paycheck as a share of the portfolio. And the second reason the hybrid 6% rule retirees dipped a touch deeper is the kicker. When the market is deeply down, both hybrid 6% rule retirees sell their entire safe sleeve, the bonds, and buy the S&P 500, catch the recovery. So at the very bottom, they are holding no cushion at all, on purpose, because they traded it away to buy the bottom. The 4% rule held its bonds the whole way down, so it dipped less. The hybrid 6% rule dipped a little deeper because they were busy buying the recovery. The extra bit of drawdown is not a flaw. It is the kicker reaching for the bottom, and it is exactly what powered the far bigger paycheck and ending balance you already saw. And that brings up something about the kicker, because it is the one part of all of this that is genuinely your call. In part 1, when the market crashed, the kicker was a rescue. The unlucky retiree's portfolio was capitulating, and selling the bonds to buy the bottom is what saved the whole retirement. They needed it. This retiree does not need rescuing. Think about who they are by the time these crashes hit. They retired at 65 years old in 1982. By the dot-com crash, they are in their mid-80s. By the 2008 financial crisis, they are around 90 years old, sitting on roughly $10 million, pulling a check that is a small fraction of what that portfolio throws off every year. This portfolio is going to be completely fine whether or not they ever fire the kicker. So here's the honest version. The kicker still fired in this backtest at the dot-com bottom and again at the 2008 bottom because that is the system and it is optimal. Firing it grows the portfolio and the paycheck even more, but it is always optional. It always was. If you are 90 years old and the idea of selling your bonds to buy stocks in the middle of a crash does not sit right with you, you do not have to do it. Your portfolio already won. You can keep your bonds, take the gentler ride, and you are still miles ahead of the 4% rule. Let me actually show you the difference the kicker makes here. If the hybrid 6% barbell retiree fires the kicker through both crashes, they end up paying themselves about $6.45 million in income over the retirement and finish with about $7 million in the account. If they skip the kicker entirely, never touch it, They still pay themselves about $5.5 million and finish with about $4.6 million in their portfolio. It is the same story on the no options side. The hybrid 6% no options retiree who fires the kicker pays himself about $4.95 million and ends with about $4.8 million. Skip it, and they still pay themselves about $4.85 million and end with about $3.6 million. Either way, on either strategy, against the 4% rule retiree who was paid about $2 million, it is not close. The kicker is the difference between winning big and winning bigger. It is never the difference between winning and losing. Let us settle the score, and let us start with the thing everybody worries about, the ending balance. In a market this good, all three of these retirees crushed inflation. Over these 30 years, inflation ran about 134%, which means the $1 million they had in 1982 had to grow to about $2.34 million just to hold his buying power. The 4% rule retiree ended at $11.6 million, the hybrid 6% barbell at $7 million, and the hybrid 6% no options at $4.8 million. Every one of them blew past that inflation mark. Nobody lost real wealth. They all won it, and it is not the interesting question here. The question that actually decides who had the better retirement is not what was left in the account. It is how much they got to spend, the income. The 4% rule retiree, sitting on the largest final portfolio balance of all, pulled just $2 million in income across the entire retirement. The hybrid 6% no options retiree pulled about $4.9 million, and the hybrid 6% barbell retiree pulled about $6.45 million. Over the same 30 years, that is a completely different retirement. That is an entirely different standard of living, different vacations, different gifts to the grandkids, a different answer every single time they wanted to say yes to something. But the lifetime total still hides the sharpest observation of all. Year one in 1982, that 4% rule retiree took $40,000. Both hybrid 6% rule retirees took $60,000. Now jump 30 years later to 2011. The 4% rule retiree is drawing about $94,000. The hybrid 6% no options retiree about $288,000. And the hybrid 6% barbell retiree about $420,000 a year. That is 3 to 4.5 times the paycheck off the very same starting $1 million portfolio. And measure the hybrid 6% rule final paychecks up against that inflation we already talked about. That same 134% inflation would have carried the $60,000 starting check to about $140,000 by the end. The hybrid 6% rule retirees did not just keep up. The hybrid 6% no options retiree ended near $288,000, more than double what keeping up would have paid. The hybrid 6% barbell ended near $420,000, roughly triple inflation. Their real buying power did not just hold flat, it doubled and it tripled. They did not just protect their lifestyle through retirement, they grew it every year on the market's dime. So here's the whole finale, both halves of it. Give the 4% rule its due. It gets you through. The unlucky retiree survived the worst sequence in history, and the lucky retiree sailed right through the best. Either way, you make it. But getting through is the floor, not the ceiling. In part one, the market was cruel, and the 4% rule left you exposed on the way down. Saved only because of a historic bull market showed up to bail it out. In part two, the market was generous, and the same rules handcuffed you on the way up. It never responded to what your portfolio was actually doing. The hybrid 6% rule is built to make the most out of both a bad and good sequence of returns because it watches the portfolio and the paycheck. It has strict rules to help you out in bad times and pay you while growing your portfolio in good times. Now that you have seen the whole system, both the unlucky retiree and the lucky one, what would you choose? What are your thoughts? What would you do in retirement? Please let me know in the comments. If this changed how you think about what winning in retirement actually means, hit the like button. And if you want rules-based retirement investing without the hype, the kind where I show you the mechanics and then prove them with decades of real data, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.